Hello guys, welcome to the lectures on long-term debt. Now in this series we're going to talk about various financing alternatives for companies and how to account for installment notes payable, understanding how the balance sheet is different as it relates to operating leases versus capital leases, talking about bonds and the characteristics of bonds, the pricing of bonds, how we issue them, and how we retire bonds. And then lastly, financial decisions and how we go about understanding concepts of financial decisions using long-term ratios. So as it relates to long-term debt, we're going to focus on long-term liabilities, including installment notes, leases, and bonds. We're going to talk about financing alternatives at the start of this lecture. Now, some of the funds needed to pay for a company's growth can come from the profits generated from operations. Profits generated by the company are a source of what we call internal financing. Many times, though, companies have to rely on funds from outside the company to pay for operations. Funds coming from outside the company are called external financing. Now, let's look back at the basic accounting equation. Assets equal liabilities plus stockholders' equity. Now the right-hand side of the equation reveals the two sources of financing: debt financing and equity financing. Debt financing refers to borrowing money from creditors, which are liabilities, and equity financing refers to obtaining investments from stockholders, which would be stockholders' equity. The mixture of liabilities and stockholders' equity a business uses is called its capital structure. Now, some companies choose to borrow money rather than issue additional stock in the company because interest expense incurred when borrowing money is tax deductible, where dividends that you pay to stockholders aren't tax deductible. Interest expense incurred on debt reduces taxable income. Paying dividends to stockholders doesn't reduce taxable income because dividends aren't an expense. So sometimes debt can be less costly, a less costly source of types of financing. A key point to focus on here is external funds can be through liabilities, which is debt financing, or stockholders' equity, which we call equity financing. The advantage of debt financing is that interest is tax deductible. So let's start right off with a question. Which of the following statements is true? A, profits generated by a company are a source of external financing. Dividends paid are a tax-deductible expense. Interest paid on debt is a tax-deductible expense. Or all of the above are true. What do you think? Interest paid on debt is a tax-deductible expense, where dividends aren't. Profits generated by a company are referred to as internal financing. So let's talk about accounting for installment notes payable. As you may have purchased a car or maybe even a house, and if you have, unless you paid cash, you signed a note promising to pay the purchase price over a period of time, maybe 4 years, 5 years, or with a house, sometimes 30 years. Car loans and home loans usually call for monthly payment installments rather than a single amount at maturity. Companies, too, often borrow cash using installment notes. So let's look at an example to illustrate this point. Assume that California Coasters obtains a $25,000 6% 4-year loan for a delivery truck on January 1st, 2018. Payments of $587.13 are required at the end of each month for 48 months. An amortization schedule shows you that the summary of the cash paid, the interest expense, and the decrease in carrying value for each monthly payment. This slide provides a partial amortization schedule for the loan. First, calculate interest expense as the carrying value times the market rate, which would be 6% times 1 out of 12 months, which would be 0.5% per month in this example. The difference between cash paid and interest expense for each month equals the decrease in the carrying value. Finally, the prior carrying value less the decrease in carrying value equals the new balance in carrying value. Notice the following features of the amortization schedule. The carrying value, also referred to as the principal, begins at $25,000, which is the original amount of the loan. Now the carrying value decreases with each monthly payment, but only for a portion of the cash paid. By the end of the 4-year loan, the carrying value equals 0. With each monthly cash payment, the portion assigned to interest expense becomes less, and the portion that reduces the carrying value becomes more. Interest expense equals a constant percentage of the prior month's carrying value. Since the carrying value decreases over time, interest expense also decreases over time. So California Coasters records the note of $25,000 as shown in this first journal entry, a cash of $25,000 debit, a credit to notes payable of $25,000. The first 2 monthly payments are also shown here on this slide. Notice that the amounts come directly from the loan amortization schedule. So as you see here, we record an interest expense. We debit the notes payable since we're making a payment. It decreases how much we owe. And the cash is the credit. So if you look at the amortization schedule here, the first payment was an interest of $125. The second payment was an interest of $122.69. And as you see here, it's taken directly from the amortization schedule. A key note to remember, most notes payable require periodic installment payments. Each installment payment includes the amount that represents interest and the amount that is a reduction in the principal. Let's do a question here. Tropical Paradise borrows $24,000 and agrees to a 5% 5-year installment loan with a bank. Payments of $452.91 are due at the end of each month. How much interest should be recorded for the first month? Any ideas on that one? Well, you're going to take the loan balance times the interest rate, and we're going to take that for 1 month. So as you see here, the payment of $452 includes the interest of $100, $24,000 times 5% times 1 month out of the annual 12 month, which is $100. The remaining portion of the payment will be a reduction in the principal. Let's look at a problem here. This is problem 9-1. On January 1st of 2018, Stoops Entertainment purchases a building for $610,000, paying $110,000 down and borrowing the remaining $500,000, signing a 9% 15-year mortgage. Installment payments of $5,071.33 are due at the end of each month, with the first payment due on January 31st of 2018. So our job is to record the purchase of the building on January 1st, and then we're going to complete 3 rows of the amortization schedule, similar to what you saw on the slide. Record the first monthly mortgage payment, how much goes to interest and how much reduces the balance of the note. And then total payments over the 15 years are $912,839. How much of this is interest and how much is actual payment of the loan? So let's start with the first piece. They purchase a building. How do we record that? Well, buildings are assets. We're going to increase the asset account by debiting building for $610,000. We used $110,000 cash, so we need to credit cash of $110,000. The note payable that we took out is an increase of a note payable, which means a credit to a liability. So we credit notes payable of $500,000, showing we issue a mortgage note payable. Next, to complete the first sections of the amortization schedule, we start with, on January 18th, a balance here of $500,000. That is the carrying value. On January 31st, our monthly payment was $5,071.33. Now we know what the interest is because we will take our loan balance of $500,000 times a 9% annual rate, divide that by 1 divided by 12 months, is going to give us an interest expense of $3,750. So $5,071.33, which is our payment, subtracted by the interest of $3,750 means the amount that will be applied against the note is $1,321.33. It's going to be the difference between our payment minus the interest expense. So that $1,321.33 is going to reduce our note. The $500,000 note payable minus the reduction in principal of $1,321.33 gives us a new carrying value of $498,678.67. That is the new carrying value in which we will now pay interest. So for the next month, we'll take that carrying value of $498,678.67 times 9% times 1 out of 12 months, 1 divided by 12, gives us $3,740.09. Again, if we take our monthly payment, which is consistent, of $5,071.33, subtract our interest expense, we come up with a balance of $1,331.24. This shows the reduction in our note payable. So we'll take our balance, carrying balance of $498,678.67, subtract it from our $1,331.24 to come up with our new carrying value of $497,347.43. Now it wants us to record those payments. So as you see the journal entry here, we will debit our interest expense of $3,750, which is taken from the amortization schedule. we're going to debit our notes payable, which reduces our balance. We'll credit our cash, which is the monthly payment. So this journal entry shows the first monthly installment on the note. Now it asks us how much of the 15 over the 15 years, the payments of $912,839 are the total payments we're going to pay over 15 years. How much of this is interest expense? Well, guess what? If the loan balance is $500,000, then $500,000 of that $912,839 is paying off the principal balance. The rest is going to be interest. So it's just a real simple, straightforward. You take all the payments, subtract the balance of the loan, the initial balance. The difference is going to be interest. Next, we're going to understand the balance sheet effects of having an operating lease versus a capital lease. If you ever leased a car or an apartment, you're familiar with leasing. A lease is a contractual agreement by which the owner, which we call the lessor, provides the user or the lessee the right to use an asset for a specific period of time. Leasing has grown to be the most popular method of external financing of corporate assets in America. In fact, many financing companies exist for the sole purpose of acquiring assets and just leasing them to others. For accounting purposes, we have two basic types of leases. We have something called an operating lease and a capital lease. Now, operating leases are just like rentals. The lessor owns the asset and the lessee simply uses the asset temporarily. Over the lease term, the lessee records rent expense and the lessor records rent revenue. On the other hand, capital leases occur when the lessee is essentially buying the asset and borrows the money through a lease to pay for the asset. So why do companies lease their assets rather than buy them? Let's take a moment to look at the benefits of leasing. So leasing improves cash flows through up to 100% of financing. When you have a purchase, most lenders require a down payment up to 20%. As you saw in the example with the building, there was a good 20% down payment, which took some funds out of the picture. In contrast, leasing may allow you to finance up to the entire purchase freeing cash for other uses. Leasing improves the balance sheet by reducing long-term debt. So if the lease is an operating lease, the lessee reports only a rent expense, avoiding long-term debt on the balance sheet. And it can lower income taxes. Many companies find that purchasing equipment causes them to be faced with an extra income tax burden based on something in the tax law called alternative minimum tax. Leasing helps avoid any additional taxes. So this slide presents Six Flags disclosure of operating leases. Note that Six Flags has over $163 million in expected future payments under operating lease contracts. However, not all leases are just rentals. Capital leases occur when the lessee essentially buys an asset and borrows the money through a lease to pay for the asset. Do companies acquiring assets through a lease prefer operating leases or capital leases? Well, let's look at the effect of both operating and capital leases on the balance sheet. And why don't you decide? Assume a company has assets of $100 million, liabilities of $60 million, and stockholders' equity of $40 million. The company then signs a new lease to purchase long-term assets valued at $10 million. This slide compares the balance sheet effects between the two methods. Under an operating lease, the $10 million lease is not reported on the balance sheet. The company simply records rent expense as the payments are made, and this expense is reported in the income statement. Under a capital lease, the $10 million lease is added to both assets and liabilities to recognize the purchase of an asset and the incurrence of an additional lease liability. While stockholders' equity remains the same for both types of leases, the relationship between total liabilities and stockholders' equity is significantly different. Under an operating lease, the ratio of total liabilities to stockholders' equity is lower, making the company appear less risky to investors and lenders from the standpoint of potential bankruptcy. That's why companies prefer operating leases. Now, a key point to look at here is that an operating lease is recorded just like a rental. In a capital lease, the lessee essentially buys the assets and borrows the money to pay for it. Let's check your understanding. Which of the following leases is essentially the purchase of an asset with debt financing? Would it be a capital lease? B, an operating lease? C, both a capital and operating lease? Or D, neither a capital lease nor an operating lease? Hope you got that one right. The capital lease is basically the purchase of an asset with debt financing. An operating lease is directly associated to rent expense. Let's look at an example here. Exercise 9.3. Coney Island enters into a lease agreement for a new ride valued at $2 million. Prior to this agreement, the company's total assets are $25 million and its total liabilities are $15 million. Calculate total stockholders' equity prior to the lease agreement. Assuming an operating lease, calculate the debt to equity ratio. So as you see here, our assets are $25 million. Our liabilities are $15 million. Plus stockholders' equity. We know the stockholders' equity has to be $10 million because the accounting equation tells us assets equal liabilities plus stockholders' equity. Now, assuming an operating lease, let's calculate the debt to equity ratio. If we have liabilities of $15 million, stockholders' equity of $10 million, our debt, liabilities of $15 million divided by our stockholders' equity of $10 million gives us a debt to equity ratio of 1.5. Now, assuming a capital lease, calculate the debt to equity ratio. So, if we need to increase the liabilities to $17 million, and our stockholders' equity stays the same at $10 million, do you see here our $17 million divided by $10 million is equal to a 1.7 debt to equity? It looks worse than using the operating lease. Why might Coney Island prefer an operating lease? Because it reports a more favorable debt to equity ratio, which is really significant when you're comparing one company to another company. Now let's identify the characteristics of bonds. A bond is a formal debt instrument that obligates the borrower to repay a stated amount, referred to as the principal or face amount, at a specified maturity date, in return for the use of money borrowed. The borrower also agrees to pay interest over the life of the bond. Now, bonds usually are issued to many lenders, while notes most often are issued to a single lender, such as a bank. Traditionally, interest on bonds are paid twice a year, which we call semi-annually, on designated interest dates beginning 6 months after the original bond issue date. For most large corporations, bonds are sold or underwritten by investment houses. The 3 largest underwriters of bonds are J.P. Morgan Chase, Citigroup, and the Bank of America. The issuing company, who is the borrower, pays a fee for these underwriting services. Other costs include legal, accounting, registration, and printing fees. To keep costs down, the issuing company may choose to sell the debt securities directly to a single investor, such as a large investment fund or an insurance company. If they do something like that, we would call that a private placement. This slide here summarizes the various bond characteristics. Secured bonds are supported by specific assets the issuer has placed as collateral. For instance, mortgage bonds are backed by specific real estate assets. If the borrower defaults on the payments, then the lender is entitled to the assets that are pledged as collateral. However, many bonds are unsecured. Unsecured bonds are also referred to as debentures. They're not backed by a specific asset. These bonds are secured only by the full faith and credit of the borrower. Term bonds require payment of the full principal amount of the bond at the end of the loan term. Most bonds have this characteristic. To ensure that sufficient funds are available to pay back the bonds at the end of the loan, the borrower usually sets aside money in a sinking fund. Now, a sinking fund is an investment fund to which an organization makes payments each year over the life of its outstanding debt. For example, say a company borrows $20 million by issuing term bonds due in 10 years. The company might put $2 million each year into a sinking fund so that at the end of 10 years, $20 million is available to pay back the bonds on the due date. Now, another key point to remember, don't you like these key points? Another key point to remember is the distinguishing characteristics of bonds include: are they collateralized? Are they backed by collateral, which means they're secure? And if they're not backed by collateral, they would be unsecured bonds. They become due at a single specified date over a series of years. They can be redeemed prior to maturity, which we call a callable bond, or they can be converted into common stock, which is known as a convertible bond. Let's look at another question. Which of the following bonds always matures on a single date? A serial bond, a term bond, a secured bond, or a convertible bond? A term bond is one that matures on a single date.